Hello, everyone. Brian Coffey here at NS Partners. Just going to run through an update for the first quarter of 2024. Kick off with an update on our firm, and nothing has changed here, really. A similar amount of assets under management for the firm and for the strategy, continued interest in the product, and no changes at personnel. With respect to performance, off to a slightly better start this quarter after a disappointing couple of years. For the first quarter, we are up 3.3% versus 2.4% for the benchmark, leading to a slight deficit on the one-year number and slightly ahead on the annualized since inception. So what happened in Q1 on the portfolio? Our usual format in terms of 3 good, 3 bad, and what worked and what didn't. So what worked over the first quarter, we had good stock selection in Thailand and in Poland. We also had good stock selection in South Korea in the run-up to their election. We were overweight the Indian market, which was positive for relative performance, and we were underweight in the Brazilian market. We were also underweight in South Africa and in China, and stock selection in consumer discretionary and in communications for the quarter was also positive, as was the underweight in materials and a material overweight in IT. What didn't work, well, our underweight in Saudi Arabia was a drag on performance, and the overweight in Thailand also didn't help. Security selection, and this is the first time that we've had this in many quarters, but security selection in India was a negative, and there was a slight continuing negative in China, although things have started to improve in our Chinese portfolio with respect to the hit rate. In terms of the securities and what worked, well, Max Healthcare in India. So despite the fact that security selection in India overall was negative, we have 2 positive names in here. Max Healthcare Institute delivered strong relative performance. The company continues to see an attractive growth outlook and is delivering good results, which is well received by the market. Varun Beverage, which we mentioned in almost every quarterly update, but the last time we mentioned it, we were talking about they had just gained a new territory in South Africa. We've since had meetings with the company, and I'm pleased to tell you that they are very excited about their prospects in South Africa, where Pepsi-Cola has a very low market share, and which they expect to grow materially. Also in China, we had a strong stock performance from Trip.com, an online travel agent, benefiting from recovery in both domestic and international travel in China. Things that didn't work so well, in Taiwan, after very strong relative performance last year, we had a weak quarter from Acton Technology. Their Q4 results were a little disappointing, and the company should improve again as we move forward. They produce key switching components in AI servers. There's concern that there may be some double ordering in this space, but these are higher margin products that they produce, and we expect that to pick up into Q2. Honhai Precision Industries is not owned by the portfolio. This is a company that's now involved in NVIDIA's server supply chain. So it had a very strong performance on the back of that. And here's one of the reasons why Indian security selection overall was disappointing last quarter. HDFC Bank was negative. They had a drop in their deposit growth, and they merged with HDFC, what used to be the parent organization, and there's been some adjustments required as they work through that merger, and we haven't seen the efficiency gains that we were hoping to see from that. Over the quarter, we reduced our exposure in China very slightly, but we did reconfigure the holdings within the portfolio. So we added to some more defensive names in China. In particular, we added to some SOE clean energy names, which worked well. We also added to PetroChina, which also worked well. And overall, the ratio of positively performing stocks to negative stocks in China is starting to improve at last. And as well as that, in the Chinese markets, we're seeing signs that share prices are starting to respond to positive results, which wasn't the case last year. So we're quite pleased with that outlook for China. We took some profits in India and we moved the weight back towards a neutral weighting. We added a little bit in Indonesia and in South Korea, and we reduced our exposure in Greece to add to a new name in Poland. Moving on to the outlook. So these charts show a couple of what we believe are important pointers to the outlook. On the left-hand chart, in the blue line, you've got real narrow money for E7 and G7. And good times for investors in emerging markets usually accompany a positive number for the combined E7 and G7. So you can see that blue line is moving back towards zero. And if it carries on in this trend, that should be positive for the asset class. At the same time, you can see the slowdown in industrial output. That would also be positive if that were to continue in its trend, as the crossover would suggest a period of excess liquidity. In the right-hand chart, you can see that we've got the ratio of real narrow money in E7 and G7 to industrial output, and that follows a long-term upward slope. And you can see that during the period from 2019 to very recently, that was above trend. So the fact that that's now back below trend, we think is very positive. So we're looking forward to seeing the benefits from that moving forward. In this chart, we're showing you the G7 and E7 real narrow money numbers again. And we're showing you, along with that in the left-hand chart, the global manufacturing PMI new orders. And you can see that the money does tend to lead that. So we've seen a bottom of for the real narrow monies, we hope, in September 2003. And the new orders normally follow that with a lag of 6 to 9 months. So we're expecting to see that start to improve as we move forward in this year. Kind of highlighting the difficult period that we've had and that we're moving into, you can see that Korean and Taiwanese exports are slowing again. That's in the right-hand chart. Well, why is that encouraging? Well, that ought to signal a weaker global economy, and the weaker global economy is what we're hoping for in terms of improving inflationary outlook and improving the monetary backdrop overall. We expect to see authorities start to cut interest rates, although obviously we're hearing with the CPI news in the US that there's some uncertainty over that. Overall, we think that these trends will continue and that there will be, even if they are somewhat delayed, there will be interest rate cuts in response to economic weakness. In this chart, we kind of show you what's going on in China. That's a crucial economy, second largest in the world, and obviously crucial with respect to what it delivers in terms of demand into emerging markets. So you can see that in China, the nominal GDP has been moving sideways. But the blue line, which is true M1 in China, there's some minor adjustments to the M1 numbers in order to get a comparable statistic for the Chinese market. You can see that there's been some pickup in that since the start of this year. So we're encouraged by that. It's not continued. You can see at the end of that blue line, it has started to roll over slightly. So we think the authorities have more to do in terms of rebuilding confidence in the private sector in China. But it seems as though they're starting to address some of the issues in their domestic economy. In the right-hand chart, you see that record PBOC lending to banks in Q4 has been followed by a somewhat of a slowdown. So we would like to see that pick up again, but overall we're becoming a little bit more encouraged by the early signs in China. Here's another chart showing the monetary conditions in China, and you can see that they have engineered a drop in the 3-month Shibor rate. So the interbank rate for Shanghai overnight banking has come down and continues to fall. So we think that the authorities are aware of the weakness in the domestic economy and are not willing to ignore it any further. And that in itself should be positive. You can see in the right-hand chart that the Chinese money numbers remain much better than those in E7 ex-China and better than the rest of the world too. So you also see black lines for the US and the brown line for G7 excluding the US. So those are starting to improve. We could hope to see that continuing, particularly the emerging market green line. If that continues to improve, it will be positive for our asset class. We've got real money recoveries in Brazil and Korea. So you can, it's quite clustered there. But the black line that was well below was Brazil, and that's moved back up into positive territory. South Africa is moving sideways at a relatively weak level, and is part of the reason why we are not positive on that market. But you can see that the majority of the emerging markets are bunched reasonably closely together and in positive territory. So if inflation continues to decline across the EM markets, that'll be positive for these numbers. The other reason why we've been encouraged by what's been going on in China is that it continues to trade at a significant discount. So in the chart on the right-hand side, we're showing the relative valuations on a price to book and on a forward PE basis relative to the rest of emerging markets. And you can see that it's trading at a near 40% discount on price to book and 35% on price to earnings. So we think that this market has been very harshly treated by markets. There have been plenty of reasons for that in terms of policy actions by the government, but we think it's now got to a valuation that is just too low to ignore. Moving forward, another positive for the Chinese market is that its currency remains very attractive. And you can see it in the left-hand chart at the bottom of the page. You've also got South Africa down there as well. And a few of the other Asian markets are in mid-level territory. In contrast, both Brazil and Mexico look overvalued somewhat to us. So that kind of tones down our take on those. What's interesting to note, and we've shown this chart in the past, is that we continue to expect a slowdown in the global economy. But the reaction of cyclical and defensive sectors between emerging markets and developed markets has been markedly different. So if you look at the blue line, that's the performance of cyclical emerging market sectors versus defensive emerging market sectors. And you can see that blue line has been in a downward trajectory. So they have underperformed. In contrast, the MSCI World cyclical versus sector has seen some very strong outperformance of those cyclical sectors. So we think that the coming economic weakness will be a challenge. Certainly will be a challenge to these relative valuations here, and we would expect to see the MSCI World cyclicals start to move downwards, particularly in relation to defensives. Whereas we don't think that the emerging markets have priced in anything other than the weakness that we are now seeing. So therefore, they should be able to steer through that period with a little bit more certainty. Here's our EM checklist. Real money growth is above G7 levels in emerging markets. We would like to see it. So that was the original blue line I showed you, is the second factor here. We would like to see positive real money over the industrial production growth gap. We don't have that yet, but as you saw in that chart, that's looking like it's quite possible soon. Valuations are definitely cheap in emerging markets overall, and in China in particular, relative to developed markets. And the earnings revisions ratios are similar in the two. Commodity prices seem to have been bottoming. In fact, you could argue that we're seeing a recovery in some of them. Some of it is linked to the Middle East. So we've seen energy prices climb with the political uncertainty there and the war that's going on undeclared. The US dollar in recent weeks has started to stabilize and rally somewhat, but we actually think that we're entering a period of secular decline for the dollar. And if that's the case, it's very positive for emerging markets. Global industrial momentum is the final factor, and that is, we believe, in a downward trajectory. And we think that will continue for at least another 6 months. So we're looking forward to an improvement in those. But overall, I would say that this is a positive backdrop for emerging markets. If you wait for all of these factors to be green, you should have been invested 6 months ago in the emerging markets, if not a year. Moving on then. This is, again, the real money numbers. And what you're looking at here is excess money numbers. We're hoping to see that blue line, which is a real narrow money minus industrial output. We're hoping to see that move into positive territory. We've got the golden line on the left, which is E7, showing better overall money growth numbers than developed markets. That's very positive. You can see from the black line that the relative performance for EM has been dreadful over the past 15 years. So the level of the relative performance for EM, so the drop in that black line, is not unprecedented, but the length of time that we've endured that sell-off is unprecedented. So we think emerging markets are in pretty good shape, were the factors that we just went over before to improve. The hypothetical performance using the excess switching rule, which we show in this right-hand chart here, shows this switching rule is a simple rule that's been designed by our economist, Simon Ward. And if you follow that, it suggests that now is a good time to switch to emerging markets, or certainly in the near future, we'll be moving more clearly towards that. And then just to summarize the portfolio strategy, we think we're at the peak economic impact of monetary weakness. So we expect that in the next 3 to 6 months. We expect inflation to fall further into late 2024. You might even get a deflation scare, although there are some signs that the problems in the Middle East and some rallies in key commodities are starting to maybe tone that deflation scare down a little. Our EM checklist is mixed, but it's improving, and we expect it to improve further. China is record cheap versus EM, and we think we're going to see further monetary recovery there. We don't need to anticipate that, but we think that's relatively positive for China. We think their currency is super competitive in contrast with Latin American currencies. And we think that EM cyclical sectors have already discounted the economic weakness ahead. So all in all, for us, that's quite a positive backdrop for emerging market relative performance.